All right, good morning, everybody. Happy 2022. It's January 12th while we're recording this podcast. So I guess I'm pretty close to being at the end of my rope with being able to say happy 2022, but I'm going to get one more in there. I'm Mike Courtney, Mass Mutual Eastern Pennsylvania, and I'm joined by Steve Parisi, who is the president and CEO of IBC Global that we were just talking about very specifically. Steve, how you doing today?
Fantastic, my friend. How are you?
Good.
Good to hear.
Excited for a new year.
Yeah.
I'm sure that, we had a crazy buckle up and ride end of 2021 from a business perspective. All good. Ton of business got pushed through, which hasn't always been the case. I haven't had those kind of typical insurance business year ends over the last few years, but this one certainly was for very specific reasons. And we're ready for a new year. So we want to talk about how 2021 wrapped up from a business perspective, from a new product perspective, and some of the different carriers that you're dealing with. And then talk about, where we think we're headed in 2022 and what your clients have in store for them as we move forward with new business. So, in general, what did the end of the year look like for you guys over there?
Yeah, it was something like I've never seen before. It was the craziest, I'd say 45 days, really mid-November, excuse me, is when it started to pick up at a high frequency, partly on the Mass Mutual side because they had that application deadline by November 19th. Same thing with Guardian as people looked at other carriers as well. But it was a mad sprint. I remember there was a span of 2 weeks where we got somewhere around 150 applications in, like total, just between all carriers, and just processing that, getting the information, trying to get them approved if you need medical records and such by year end. That was challenging. We got a big chunk of business through, but a large chunk also did not get through, where now we're looking at the newer products. Excuse me, I'm getting over a bug. But it was crazy, to say the least. So, we had everyone going just 7 days a week, just like you. I know you guys were nonstop in fulfilling all the questionnaires, the application requests, and then still being thorough with people. Like our big thing as a company is to provide
Not rushing.
Yeah, transparency, show the different options, take the time so no one feels rushed. And to do that when you are rushed because you've got an actual deadline coming up, that was a case where I'll step in, help wherever I can, show the information as well, the different policy options, and then let the person decide from there, knowing that they've got a deadline, which was...
I'm surprised actually that many of your clients were that keen and focused on locking in the old guaranteed rates.
Yeah.
As opposed to to summarize the product changes, and I don't know if you can summarize them that much across the board, carrier to carrier, but if I had to really oversimplify it, do you think I'm on the right path to say the old products had better guaranteed crediting rates?
Mm-hmm.
The new products probably have better ability to drive more cash accumulation.
They do. You got more potential with them. That was a good summary. You've got, with the new products, you have lower guaranteed rates between 2 and 3.75%. You also have higher PUA rider fees for the most part with most companies and products, which impacts the upfront cash value, the break-even point. When a lot of people, real estate investors and business owners, do look at that quite a bit. So when they look at the old and the new and say, hey, long-term, the options are similar. The new product does have a little bit greater long-term potential, but I like that upfront cash value a bit more. Not that I'm even going to use it. I just like to see it there because it's my money. We get that mentality quite a bit, and I get it 100%, especially if you're a business owner. That I think was a big driver of the older product, where they liked that a little bit stronger upfront cash value, which was not due to the higher guaranteed rate. That's a result of the increased PUA fees that most companies have assessed on their products.
Right.
Yeah.
Well, really, if you're breaking it down, like I know that you are so analytical and so specific, and a lot, and so a lot of your clients are as well. I feel like a lot of times when I'm looking at this stuff, we get lost in the weeds of these little nuanced changes in product.
Yeah.
These changes really material?
They
Do you
are.
notice significant change, whether it's good or bad?
So, I'll do my best to not go super deep into the weeds, which I've got a problem with often. When you look at the new products and old products, let's start with the old products. I always state, and I still firmly believe this, if you do everything right, have a whole life insurance policy with one of the major mutual carriers designed with a low premium, high PUA allocation, you can expect the net internal rate of return to fall somewhere between the 3 to 5% range over time. Like that's what you can expect.
Right.
Based on actual data, all the historical stuff we always see. With the new products, I would expect the exact same thing between that 3 to 5% range over the long haul.
Right.
The difference is upfront because of those higher PUA fees, you will feel it a little, it's not huge, but you will feel it. You'll have typically around, call it 5% less with the new products in the first year than the old products, which a lot of people look at that and say, all right, I'm not going to use, I don't need access to another,
That's
another
not
5%.
material. Someone else may see it as material.
But some people do, yeah. So how I try and look at it personally, like when I'm paying my money.
Not to interrupt you, but then that pushes out your crossover.
Correct.
Right?
Which is important to people. Yeah.
Yeah.
It is, and I know some people don't care, but if a consumer cares about it, they say, hey, I'm very concerned about the break even, the upfront cash value, long term as well, but I want to see the cash upfront. That's what I like, the consumer, that's what they want. I'm going to focus on that. I'm not going to try and convince them not to do it. I'm going to show them options that have greater long-term potential with less upfront so they can see everything. But it's ultimately what the consumer wants. So I want to listen to what they're saying and show the options that are in their best interest based on really what they want to accomplish, because they know what they want. I'm not in their mind. I'm not reading it. I can ask questions and get a good sense, but it's still them at the end of the day. Mm-hmm.
So, but we both experienced crazy, not in a bad way. I mean, just a ton of business trying to get pushed through.
It was nuts
for year end.
Yeah.
It was great, actually. Now, as we're turning the corner, starting a new year, everybody's starting with a clean slate. All these carriers now have this in their rearview mirror for the most part, and we're dealing with these new products. What are you excited about, and what are you concerned about, maybe from a carrier or a product perspective?
Yeah, good question. The biggest concern, and this is just probably me and everyone being a creature of habit, is when you look at the guarantees on whole life insurance policies, it's still a whole life product, meaning the guaranteed rate, the guaranteed interest rate will always exceed the insurance expenses, and you'll see your guaranteed cash value go up no matter what as time passes. And that's a fundamental difference between whole life and IUL. With whole life policies, you're guaranteed to go up no matter what. With IULs, with the guarantees, that doesn't happen. And that's not a shot at IULs, but you still have that core benefit to a whole life insurance product. But when we compare, here's what it used to be, the good old days, to what it is now, the guarantees are a little bit weaker. For example, you could take the old Guardian products. I would look at them frequently. And if you do things right, have a break even between years 5 and 6 often on a guaranteed basis, which is strong, right? If you stuff that policy properly. Doing the exact same thing with the new products, and this is with Guardian with their guaranteed rate, not at 4%, but at 3%. PUA fee increased from 5 to 10%, so less upfront. The break even point in that exact same scenario, instead of breaking even between 5 and 6, is now between years 8 and 9. On the guarantees. And also, when you look at the top companies, they've operated in a non-guaranteed environment for the past 150 years. Like paying dividends, not charging the max charges for term riders and such. So, we don't always have to look at the guarantees, but just to look at the differences there. If I were to answer your question and say, hey, what's not as good? What don't I like as much? The guarantees. When I look at the PUA fees, they're higher, a little bit less upfront, just to be transparent, going through the good and the bad. So that's what I don't like about the new products as much. A little bit less death benefit too for someone concerned about that in a cash value sale. Any questions on that before I get into the good?
I mean, I guess my question would be, I understand your sales process and I know the kind of detail that you go through with clients, because just to break it down for anybody who's listening, with a whole life policy, as long as that company declares a dividend, the guaranteed projections are kind of irrelevant in my mind. So it's nice to have those guarantees to back up this product that you've purchased. But I'm just going to speak for Mass Mutual, but the same goes for the other mutuals. Dating back to the 1860s, Mass Mutual's declared a dividend every year for its policyholders. So literally the guaranteed values have never real world really been applicable. Are you comfortable removing that from from the conversation?
Yeah. Mm-hmm.
I mean, a lot of, it's not
I feel you.
It's not a deceptive type of thing. Like I've been with Mass Mutual for 10 plus years.
Yep.
I don't talk to people about guarantees ever.
Yeah.
Not because I'm avoiding it. It just never comes
Doesn't
up.
come up.
Yeah.
Yeah. Good question. So why I like to talk about it is what I have found over the years is very, very frequently consumers will ask about it. And I get we're a bit unique in our market. We're focused on the cash value. But a lot of times people do ask about it. And when I noticed that question kept coming from different consumers with different backgrounds and different professions, what we started to do was market it. Like, whenever we create any type of marketing, like videos and such, they are always based on consumers or case studies that come from, or questions or case studies that come from consumers. Like I want to hear what they're saying and then answer their question, and then also serve a broad audience. Because if you're my ideal client and you're asking me about guarantees, that means other people like you have that same interest, where either they'll ask, or if you show it to them, it's like, oh, I didn't know that. That's actually good awareness. Thank you.
That'll turn them on. Yeah.
Yeah. And then all of a sudden you're the group I want to work with. So it does help from a marketing standpoint, providing that transparency. So will we stop doing it? Probably not. But we don't always...
exactly what you just said,
Yeah.
The last couple of sentences really makes a lot of sense. You never know what's going to pique somebody's interest or what's going to grab someone or, kind of turn a light switch on. And you have found that, for some certain demographic of people or some certain kind of wired mentality type of people, that's a real applicable topic that grabs some eyeballs.
Yeah, and it's also an objection on a frequent basis as well. If you're up against a financial planner that does not like whole life insurance, and says, "Oh, you always got to look at the guarantees" or something like that. What I have found is, whenever you're being transparent and going through the good, but also the bad, and even the outright ugly about your process, your product, whatever it is that you're selling and discussing, that completely eliminates any objection that might be thrown at you, because you showed the client first, here's the good, here's where people have expressed concern, here's the reason why, this isn't very likely to happen, but we just want to be transparent with you as well. This way, when someone comes in, because this happens a lot, I think you've probably seen this a lot more than me. Oh, you got to be aware of whole life insurance, make sure you look at the guaranteed ledger. And then it's like, yeah, my guy showed me that, here's what it is. Then all of a sudden it's like, okay, this other guy's trying to attack. When you're just being transparent with the numbers, it's like you can't lose there. You're just being open with everything. Yeah. Mm-hmm.
Makes sense. So then what about what are you excited about this year?
Yeah, so excited about a lot.
I mean, you're always excited about a lot of stuff.
Yeah. You gotta have fun with this stuff, man.
Yeah.
Like, what else are you gonna do?
Yeah.
Yeah. So focusing on the products, if I were to start with those, just because we talked about the bad, I don't want to I don't want to leave it at that. For the individual that is laser focused on cash value, which is typically who we deal with, when you look at the new products, the benefit is really in the long-term potential. What has happened with this change with lower guaranteed rates? You need less death benefit to get the same MEC limit without getting into the details there. Basically, it means we can have a little bit lesser insurance expense, which with lesser expenses, you can see greater long-term cash values on a policy. So you do have greater potential when you look at whole life insurance and cash accumulation, which is great. When you look at the upfront cash value, it's still attractive. I mean, if you do everything like what people are used to that work with us, if you do everything right, you'll typically see your first year cash value between 80 and 90%. The break even, to set expectations properly, I'll often state it should fall somewhere between years 4 and 6 in most cases. Before it was years 3 to 6, 3 to 5. So that's the PUA fee.
Yeah.
Some companies, I like what MassMutual did. It was a huge update with the 4 different guaranteed rates, and then also with their PUA fees with their lister and ailer. They increased it on most products, but some products they didn't. Like their Mass 10, their whole life 10 pay and their whole life 15 pay, they didn't increase the PUA fees.
Yep.
So granted, they're limited pay products, but just when you look at them for the individual that says, I want maximum internal rate of return. I don't want to have to pump money in. A guy just messaged me, or I think he commented on something yesterday saying, I'm 50 years old. I don't want to have to pay into a policy for 30 years. Like he wants a short funding period.
Right.
Those particular products will credit strong IRRs. They have lower PUA fees, so you don't experience the upfront hit. The break evens typically between 4 and 5 with strong long-term performance. You can tell I'm nerding out with this stuff, but just with the variety of options that are now are available with Mass and other carriers, as an agent, you really need to be on your game if you're in the cash value space. But as a consumer, you have a variety of options to select from to really make sure you can get the absolute best option out of the gates and just, put the hammer down and go a million miles per hour.
Besides what you just talked about with Mass, did any other carriers make any changes that you're really excited about, or just kind of, change to the guaranteed rates and change to the MEC limits?
Yeah, the guaranteed rates and MEC limits is across the board. Not really. Most companies just filed at a 3% guaranteed rate.
Because like Mass did the other thing that you didn't mention, that really I think is kind of the only other thing that I was excited about with the changes to the Mass product is a couple of the products have lower policy loan interest rates.
Oh yeah. Completely
so
forgot.
When we're working on a sale where we're solving for future income or we're looking for supplemental retirement income, I've got multiple products that have a much lower policy loan interest rate that can drives a lot more potential income out of that policy. I haven't seen that anybody else has done anything like that. Anything else you can think of that's kind of out of the box?
Yeah, I can go through, excuse me, a little bit of that. What most companies done, like Mass, for example, whatever the guaranteed rate is, when you look at the variable loan rate, it's always plus 1%. So for example, the 10 pay, your guarantee's at 2, all this. The variable loan rate is then at 3%. If you look at the 15 pay, the guarantee's at 2.5%. So the variable loan rate floor is 3.5%. So it's just whatever the guarantee is plus 1, which is exactly what it was before. The guaranteed rate was 4 and the variable loan rate floor was 5%, and still is if you have an old Mass product. So when you look at other carriers, they've done almost the same thing. For example, if you look at Guardian's old product, they had a guaranteed rate of 4% and a fixed loan rate of 6%. However, that fixed loan rate was fixed for 10 years, and at the 10th year, you could elect to change that to a variable loan rate. It would then become non-direct recognition, and that floor was 4.5%, still with a guaranteed rate of 4%. With the new change, you've got a 3% guarantee, so the fixed loan rate has dropped from 6 to 5%. At year 10, you can elect variable with non-direct recognition, which has a variable loan rate and a floor of 4%. So similar trend, just where they dropped everything. And if you keep the fixed rate, what happens with the old one at age 65 or year 20, whichever comes last, the fixed rate actually drops down to 4% with the old product, and with the new one down to 3%, matching the guaranteed rate. So all companies have their own way of doing things. But what I've noticed as the guaranteed rates have dropped, the loan rates have dropped proportionally as well, which is good. It evens things out. Yeah.
Yeah.
Sorry if I got too
Well,
technical.
I know that you and I, you're going to help me with this, but in 2022, I know we're going to press gently but very firmly on Mass to be a little more flexible with how they're receiving premium dollars and how we fund policies, and always with the mindset of, we really want to deliver what the consumer wants. I was trying to look at this as, I'm a consumer, and at the end of the day, what I would want most would be a product that's going to give death benefit protection to my family, but also that I can, on the fly, be stuffing money into that's going to grow tax free, that I can access via a loan and then repay that loan and get some really strong cash value performance out of that.
Yeah.
So I'm going to keep pushing on Mass Mutual. They've made some of those changes over the last couple of years that looked like we were headed in a positive direction, but I feel like there's still some things that are lagging behind a little bit.
Yeah, but overall, like with the new 7702 change, I was probably surprised with a lot of carriers, but them quite a bit in a good way, where they have outright stated some products are designed and the sole purpose is cash accumulation. Not the sole purpose, but the primary purpose is cash accumulation.
Yeah.
Where there was some resistance to that in the past. But they're like, hey, like if somebody's interested in high cash value, like 10 pay, 15 pay, these products accommodated. Others do too, like they're higher cash value, all of them really.
Right.
But they came out with that messaging, which is, I love it. Obviously, I would in my space, but I think it's a good sign. And it also makes them very competitive because they're a force, man. Like everybody knows who they are. So if they can embrace that a bit more in some ways, they'll really be able to do some nice things.
Yeah, I agree.
Opinion. Yeah. Fun stuff.
Well, I know we'll be doing some nice things this year. Anybody out there who is interested in learning more about any of the things that Steve and I talk about, feel free to reach out to Steve Parisi directly. You can find all these chats on the IBC YouTube channel, along with endless amounts of other content that is all things cash value life insurance and policy design and underwriting questions, and really breaking down how some of these carriers operate and what you need to know if you're interested in this space, either as an agent or as a client. If you want to talk about Mass Mutual life, disability, long-term care, fixed annuities, feel free to reach out to me anytime. Mike Courtney, Mass Mutual, Eastern Pennsylvania. Steve, thanks for the chat today. I hope you have a great week, and we'll be catching up soon.
Likewise. Thanks for your time as always.
Thanks everybody.
Enjoy.